Existing home sales in September declined 1.9% to a seasonally adjusted annual rate of 5.29 million unit pace, from a downwardly revised 5.39 million unit pace in August. On a year-over-year basis, in September, so September of this year versus September of last year, home sales were still comfortably higher by 10.7%. It is worth mentioning there appears to be some loss in momentum in the year-over-year figures because it had been 13%, 15%, 17% year-over-year changes, and the latest 10.7% year-over-year change is the slowest in 5 months. The national median existing home price in September was $199,200. Repeating, $199,200, which is an increase of 11.7% from 1 year ago. We always measure median price from 1 year ago because there appears to be seasonality on the prices because larger homes get sold during the summer months and then smaller size homes get sold during the autumn and winter months. Just as with home sales, where we saw some loss in momentum, there appears to be also a loss of momentum in the year-over-year home price gain. So it had been things such as 13% increase, 14% price increases. The latest of 11.7% increase would be the slowest increase in 5 months, just like in home sales. The mix of home is certainly at play, but if home prices appreciate, that means you have fewer homes on the lower end, just period. So as home prices continue to appreciate, we are seeing far fewer transactions on the lower end. But nonetheless, statistics-wise, sales of homes, those under $100,000, declined 7% from 1 year ago, while sales of homes priced $500,000 and over were up roughly by 40%. So one see a strong divergence in which market is moving now versus 1 year ago. Inventories. At the end of September was unchanged from the prior month. There were 2.21 million homes available for sale. From 1 year ago, it is an increase of 1.8%. This is the first time in 2.5 years we saw an year-over-year increase in inventory. So we have been witnessing falling inventory, and in September, a modest increase. So does this represent an inflection point, a beginning of some additional homes coming onto the market to relieve the price pressure? It remains to be seen. It's only a very modest increase. I would say that inventory overall probably would need to increase to about 30 or 40% to get us into more balanced condition. But nonetheless, it is the first increase in inventory year over year in 2.5 years. What to make of the latest month's data and what to anticipate going forward? We expected some declines in home sales. First, because the sales in the summer were surprisingly strong, much better than what I anticipated, what most economists anticipated. So from the higher base comparison, it was bound to come down. Furthermore, affordability is getting hit quite sharply. Affordability levels are now at a 5-year low. You have a combination of fast rising home prices while income is barely budging. So you have home prices rising in double digits, income barely rising, and then you have now higher mortgage rates compared to 1 year ago. So the lower affordability will hamper home sales going forward. Shutdown impact. I think today's data is really not reflecting any of the shutdown impact. we will see some of that or try to decipher some of that in October data. But I expect that the shutdown impact is really just a delay. So whatever shortfall that we see in October will be made up in November and in December. But given that there will be another potential shutdown and potential debt ceiling debate in January, February, it remains to be seen how the consumer respond to another case of being on the brink of chaos, whether consumer completely dismisses it as a cry wolf event or whether he begins to hammer away at the consumer confidence, because consumer confidence is clearly important to buy a home.